It's been a go-go market. I mean, it just keeps going. Certainly hasn't paused this year. It's been straight up actually since October of last
Yeah.
year. We had a bit of a correction from August to October last year, but it's also been more or less straight up with a brief 10% correction since October of 2022. So it's been a phenomenal bull market.
And Tom, for those our viewers on YouTube, that is a bookshelf. I have like 3 books on my book. Dr. Yardeni has a bookshelf.
That's every book. Excuse me, the blue button. The blue button is the Detroit Lions button. Thank you. Yardeni's got up there every book Robert Schiller's ever written.
Exactly.
That's what it is.
So Ed, I mean, one of the things that I think concerns that some people have now is just, boy, if we've gone a little bit too far, too fast over the last 3 to 4 months, because we haven't seen earnings necessarily follow the performance of some of these risk assets.
Well, we've seen earnings turning out to be surprisingly good for the mega cap 8. Those stocks have done quite well, and we've seen, as a result of that, we've seen these stocks do very, very well. But overall, the economy is doing very well, and earnings, I think, are going to be something like $250 per share for the S&P 500 this year, and that would be up from $220 last year. And then beyond that, I think we'll see earnings continue to grow into 2025 and 2026. I don't see a recession. I think it keeps going.
Ed, I want to frame out the shock 60 days ago where you said we're going to 5,400 SPX. I did the fancy math and got the Dow Jones Industrial Average out to 43,000 on that number. Do you get any sense that there's Schillerian exuberance out there? Are we getting a Robert Schiller, Alan Greenspan irrational exuberance? I don't feel it.
I think we've got exuberance for sure. And then it's debatable whether it's irrational yet. Right now, it looks like rational exuberance. We still have a lot of money just parked on the side earning money market funds. We got something like $6 trillion just in money market funds. So money isn't exactly pouring out of short-term assets.
Yes, I don't see it.
Market.
Well, just quickly here, is it going to go? Is the money market fund going to support the Yardeni 5,400 SPX?
Well, 5,400, it doesn't look so amazing anymore.
I'll say.
That's why I'm talking about 6,000 by the end of next year.
There we go.
5,400 isn't as impressive as 6,000 by the end of next year, given how much territory we've covered.
Ed Yardeni with us. I can't say enough about his research. It comes in different platforms. Yardeni Quick Takes is worth its weight in gold. It's short, focused, and it synthesizes in his Yale economics, all of his work on Wall Street over the decades, into a call on optimism in the American economic experiment. To wit, and I go back to what I call the Yardeni Ancampora low, 2 giants, Ed Yardeni and the technical analyst Ralph Ancampora, lonely in October of 2022, and to get up to the Dow equivalent 46,000, which is Ed Yardeni's SPX 6,000, is a lift of 61%. Dr. Yardeni, is that a normal lift out of an angst time when everybody's gloomy? Is up 60% normal?
Well, it doesn't come with a money-back guarantee. I mean, we always have risk in our forecasts, and we have to acknowledge that there are risks. There are geopolitical risks. There's always the risk that the price of oil spikes up again. But my base case is what I call a roaring 2020s. It does rhyme with the roaring 1920s. And in this case, I think the technology innovations that are out there to boost productivity are already working. There's a significant shortage of labor in our country, skilled labor, and technology is going to solve that problem.
On productivity, and again, the Mauboussin Callahan Morgan Stanley essay is brilliant. It's February, and it's already my essay of the year. What's that about? Maybe subject to change. But on productivity at Yardeni, it's about corporations adapting.
Right.
There's layoffs, there's right sizing, and that. It's not about cost cutting. What's it about? A new efficiency?
I think it's exactly about a new efficiency. It's technology-led. It doesn't mean that people are going to lose their jobs. I mean, there is always churn in our labor market. We are seeing in some of these technology companies cutting back in areas where they just don't see much upside anymore. But I think most of those people are going to find jobs very, very quickly. They're very skilled, and there's a real shortage of skilled workers. I think what technology does is it augments the productivity of workers, and therefore allows for the economy to grow more quickly. The labor force has only been growing around 1% or less over the past few years, and that's all we have to look forward to with real GDP if there's no productivity growth. But companies and businesses and entrepreneurs are aspirational, and they are going to use technology to increase productivity, and it's already happening.
Yep.
We had an amazing 3 quarters last year. Last 3 quarters, productivity was extremely strong.
Yeah.
For the year as a whole, it was 2.7%.